On August 15th, 1971, President Richard Nixon appeared on television screens across America and announced a decision that would permanently alter the architecture of global finance. He was closing the gold window. For the first time in modern history, the United States dollar would no longer be convertible to gold. The Bretton Woods system, the monetary framework that had governed the world since the end of World War II, was dead. But this wasn't a sudden decision born from ideology or ambition. It was an act of desperation. By the late 1960s, America was hemorrhaging gold. The Vietnam War was draining the treasury. Social programs were expanding. And foreign governments, sensing weakness, began demanding gold in exchange for the dollars they held. France, under Charles de Gaulle, was especially aggressive, converting dollars into gold bullion and shipping it across the Atlantic. The United States simply didn't have enough gold to back all the dollars circulating in the global economy. The system was breaking. Nixon had a choice: default on America's promises or rewrite the rules entirely. He chose the latter. What Nixon called a temporary measure became permanent. The gold standard was gone. In its place emerged a world of fiat currency, where money derived its value not from precious metal, but from trust, from government decree, from belief. Central banks could now print money with far fewer constraints. Inflation, which had been relatively tame under gold, began to surge. By the mid-1970s, the American economy was caught in stagflation, a toxic mix of stagnant growth and rising prices that classical economic theory said shouldn't exist. The oil shocks of 1973 and 1979 made it worse. OPEC, realizing that the dollars they received for oil were worth less and less, quadrupled the price of crude. Gas lines stretched for miles. Inflation hit double digits. The world was adjusting, painfully, to a new monetary reality. But the end of Bretton Woods also unleashed something else: financial innovation. Without the anchor of gold, currencies began to float against each other. Exchange rates became volatile. Banks and corporations needed tools to manage risk. Derivatives markets exploded. The foreign exchange market grew into the largest and most liquid market on earth, trading trillions of dollars every single day. The financial industry, once a relatively staid corner of the economy, became a dominant force. Wall Street boomed, and the dollar, paradoxically, became even more powerful. Untethered from gold, it was now backed by something more flexible and more potent: the full faith and credit of the United States government, the strength of its military, the depth of its markets, and the inertia of global habit. This new system had no formal rules, no international agreement, no conference in a resort town to codify it. It emerged organically, chaotically, and it concentrated enormous power in the hands of the Federal Reserve. The Fed could now expand or contract the money supply with unprecedented freedom. It could fight recessions by printing money and fight inflation by raising interest rates. But it also meant that every nation holding dollars was now exposed to American monetary policy. When the Fed raised rates, it didn't just affect Americans. It sent shockwaves through emerging markets. It triggered debt crises in Latin America in the 1980s. It influenced the Asian financial crisis of the 1990s. The world was now tied to the dollar in a way it had never been tied to gold. Critics warned that a fiat currency system was inherently unstable, that it would lead to reckless spending, unsustainable debt, and eventual collapse. And they weren't entirely wrong. National debts exploded. The United States went from being the world's largest creditor to the world's largest debtor. Financial crises became more frequent and more severe. The 2008 collapse, the European debt crisis, the rise of quantitative easing, all of these were downstream consequences of a world unmoored from any physical constraint on money creation. But the system endured, not because it was perfect, but because there was no alternative that the major powers could agree on. Today, more than 50 years after Nixon's announcement, the debate over money has returned with new intensity. Cryptocurrencies like Bitcoin have emerged as a direct challenge to fiat currency, promising a return to scarcity and decentralization. Central banks are exploring digital currencies of their own. China is pushing to internationalize the yuan and reduce reliance on the dollar. And yet, for all the upheaval, the dollar remains the world's reserve currency. It remains the currency in which oil is priced, in which international debts are settled, in which global savings are stored. The ghost of Bretton Woods still haunts the system, but the world Nixon created endures. What Nixon did in 1971 was not just an economic decision. It was a geopolitical gamble. He bet that the world would accept American currency without the backing of gold, that trust in American power would be enough. He was right. But that trust is not infinite. It must be maintained. And every time the Fed prints another $1 trillion, every time the national debt climbs higher, every time a foreign power questions the fairness of a dollar-dominated system, the question resurfaces. How long can this last? Nixon killed gold. But he created something far more powerful and far more fragile. He created a world where money is belief, and belief can be shaken.